Hello and welcome to Indianomics. This is the big week, the one before the credit policy and the on-the-dot fiscal deficit number for FY17, the cut in small savings rate and the higher than expected fall in food prices have all led to expectations of a double dose rate cut on April 5th. Now, bond dealers separately want more liquidity in the banking system. Bankers have just cut their so-called marginal lending rates, but they are more interested in knowing whether there will be some help or more strictures on bad loans. Well, I have a star panel to discuss all this. Jahangir Aziz, the chief economist from JP Morgan, Jayesh Mehta, the country head of Bank of America Merrill Lynch, and Srinivas and Varadarajan, deputy managing director of Axis Bank. But gentlemen, please wait a minute. Let's first hear out my colleague Ritu Singh, who has just polled a whole lot of economists and bankers on their expectations from the policy.
The government has walked the talk, and now it's over to the Reserve Bank of India. With Finance Ministry sticking to its fiscal deficit target and also cutting small savings rates, all the top economists and treasury heads polled by CNBC TV 18 expect Governor Rajan to deliver a rate cut. According to CNBC TV 18's poll, a majority 75% expects the RBI to cut repo rates by 25 basis points on Tuesday. Another 20% is even expecting a 50 basis point cut. Both CRR and SLR are widely expected to be left unchanged. And this will not be the end of the rate cuts either. An overwhelming 95% of the respondents say RBI will remain in an accommodative mode. 50% expect a 50 basis point cut in the entire calendar 2016, 20% expect a 25 basis cut, and another 20% are hoping for a 75 basis point reduction in the key benchmark rates. 55% of respondents expect the tone of the statement to be similar to the Fed policy, but 35% are expecting a slightly more dovish tone. On the macro indicators, the majority believes the GDP forecast for FY17 will be maintained at 7.6%. But it is Governor Rajan's comments on inflation that will be more closely watched. An overwhelming 90% of respondents believe that RBI will keep the January 2017 forecast of 5% CPI inflation intact. But come Tuesday, the bigger question RBI faces is the tight liquidity in the system. Markets and banks will be watching out for his comments on liquidity management. Half the respondents believe Rajan's statements on that will be as important as his statements on rates. They will be keen to hear about a committee which Rajan promised to appoint to review the liquidity framework. The other points to watch is whether he gives banks some breather in their battle against the bad loans. In Mumbai, Ritu Singh.
The key takeaways from Ritu's poll is that the repo rate is expected to be cut by a good 75% of the people by 50 basis points. And nevertheless, on the inflation poll, Ritu finds that almost everybody, 90%, expect the inflation forecast to remain unchanged at 5%. So what people are actually expecting is a majority are expecting that repo rate will come down to 6.25%, but inflation will remain at 5%. Now that's not gelling much, but let me get to our experts. Well, first up to the economist. Jahangir, what's the sense you're getting? Space for 50 basis?
Yeah, that's about, what you can make out. There's probably space of 50%, but, the question is, if you do a 50% and then give, signs that that is the end, and we saw that happen last year, then I think the market will not be very happy. So you can't have a hawkish cut. So I think it's, if the RBI is going to do 50%, they have to dangle further rate cuts or the possibility of further rate cuts in the future. So I think that's one possibility. The alternative is to play it very safe and do a 25 with a more convincing promise of a 25 basis points rate cut later on. And that I think will avoid the expectation that this might be a hawkish cut. You really need a dovish cut at this point in time. I think whether it's 25 or 50 basis points, that's something that the RBI has to decide. But really, you need a dovish cut to keep the market happy.
Okay, give me a one-word answer. A dovish cut of 25 or a hawkish cut of 50? What's your choice? What's your expectation?
I think it's going to be a dovish 25 cut, but with a promise of another 25.
Okay. Well, first let me get that one quick answer out from the other panelists as well, and then go for more. Srini, what are you expecting?
See, I broadly agree with what Jahangir is saying, but again, the one you started off with saying rates and liquidity, and it's very difficult to be hawkish at this point of time when everywhere on the world things are looking like again going further downhill, and you got negative rates, and the US also talking of slower rate hikes. So overall, the environment is something where it's difficult to be hawkish from a rate perspective. If you had looked at what you said in terms of the fiscal deficit and other actions which the government has put in place, clearly the expectation was some of the market expected that rate cuts would have happened, say, immediately post-budget. I think that ammunition has been withheld, clearly with an intent that with the MCLR kicking in on April 1st, I think transmission to some extent is possibly likely to be more, and therefore why waste the rate cut before the MCLR kicks in, and therefore let the MCLR come through and therefore then cut rates. So I would think that cut 50 and make sure that you send a strong message on liquidity, that there would be adequate liquidity and there would be adequate measures being taken to make sure liquidity is available. And that to some extent will negate in terms of trying to take a call on whether this is the last of the rate cuts. Meaning void liquidity, cut 50, therefore from a transmission perspective you try and make sure you get the best outcome in terms of whatever ammunition you have. And we've always been surprised on inflation being possibly softer than what we'd anticipated till now. And nothing in the world has changed for us to change that. Of course, core inflation continues to be sticky, but I would still believe the inflation can still continue to be fairly well moderated. And to that extent, I think space which we never thought will be at 6 quarter. But now we are talking about 6 quarter. So
well, I'll carry the liquidity argument in a bit. But basically what you're saying is you would have said it would be a hawkish cut of 50. My assumption is that if it's a 50 basis cut, it will have to be hawkish because the remaining chances are not there. But the governor can moderate it with liquidity, is your point. I'll just come back to you.
The point I'm trying to make, cut 50, maintain the accommodative stance and assure liquidity. So that way I don't think the turn becomes hawkish.
I will try and argue that may be asking for the moon, but I'll pose that question to Jahangir in a bit. Jayesh, what are you expecting? 50 or 25 and the tone?
I think Srini just in his closing did talk about my expectation, which is 50 to make an accommodative stance. And as the world today, right, there is no case to be hawkish about it, the way the world is moving. As of right now, the way the world looks much softer. Of course, things can change later, that's a different story. So, but on 5th of April, there is no case for being hawkish even if you do 50. So, yes, one can say no further rate room may not be there, that would be hawkish, but accommodative stance itself would be good enough. So, 50 and accommodative stance is, I would say, the hopeful thinking.
Okay. Well, as promised, I will come back to the liquidity argument, but Jahangir, you know, the core inflation, as you pointed out, is at 4.9, as Srini said, 4.9, almost 5%. The governor has always wanted a 1.5 percentage point difference between inflation and his signalling rate. So at 6.25, I'm sure the 1-year forward rate will be a little higher. So, you know, the difference is not there. Is there a scope, therefore, if everybody agrees that inflation is going to be 5, then after 6.25, where is the scope? Wouldn't that be the last of the cut? So, per se, however he put it, wouldn't that be hawkish?
Right, I mean, so that's where I think what Srini and Jayesh was saying comes into play, that can you therefore say things on the liquidity front, which would give you much greater belief that even if there may not be further rate cuts if you do a 50, but at least the liquidity situation will be more easier. But my sense is that it is very difficult to foresee where, unless the RBI is going to do significantly more OMOs than what is required to keep base money, whatever it is that is required, given inflation rate of 5% and growth of 7.5%. To provide more than that liquidity looks unreasonable at this point in time. So I take both Srinivas and Jayesh's point that, look, 50 with a more accommodative promise of more accommodative liquidity is the best thing. But I think it might be a bit difficult to deliver that. On the other hand, this RBI and this administration has proven time and again that when they want to move in big steps. So, you could see 50 with an accommodative stance, but it is hard to see balance of payments flows, what the amount of base money creation is required to keep this economy going, to deliver reasonably large amounts of liquidity support.
Okay. No, my fundamental problem really is that the difference between the inflation rate and the signaling repo rate, the governor wants to be 1.5 percentage points, and once you're at 6th quarter, I don't see how you can be give the 50 basis as well as sound accommodative.
Just one correction. I think last time in the policy, I think the 150 or 125 was not pegged to the policy rate. It was pegged to the
1-year T-bill
rate. That gives you more
the 1-year
space.
T-bill is...
it gives you more space.
Okay. It gives you... the 1-year T-bill perhaps is at 6.5, so that might give you
more space.
But let me get one liquidity answer in and then continue the conversation. We'll have to take a break. Jayesh, the big accommodative gesture provided by the governor last policy was that he will set up a committee which will look at the framework of liquidity. What are you expecting? Do you think he has to say that 1% deficit of the total deposits need not be maintained, that he can be surplus liquidity? What do you want to hear from that liquidity framework committee?
So there are two things there. I think first and foremost, when we are saying liquidity accommodative stand and liquidity being provided, I think one visible difference which we didn't get last year, I think the repo liquidity, which is collateralized borrowing, when we need to infuse liquidity, it's also reflecting on bank deposit growth. When you need to increase liquidity, it has to be uncollateralized infusion of liquidity. So maybe it's not necessarily, when we say infusion of liquidity, not necessarily OMO purchases, not necessarily other things. Maybe the surplus government balances can be, actually we have been talking about it, can be with the nationalized bank. So why not do that? So that will take care of liquidity. We all require is basically permanent liquidity in the system, or even uncollateralized liquidity. The problem today is it's all collateralized liquidity which is being provided. And maybe if I can ask a question, maybe to Jahangir also, is we have if you look at the macroeconomic parameter, right? We have the best macroeconomic parameter as of right now. Your fiscal deficit is in control, your small savings rates has been cut, your current account deficit is in control, oil prices, global commodities prices, oil prices helping us. And of course the global rates also is helping us. So in that situation, if you don't go positive on liquidity, when do you go positive on liquidity? That is surplus liquidity in the system.
Jahangir, time for surplus liquidity?
I think that train has left the station, Jayesh, 5 years back. I mean, that has been the framework in which they have been operating for the last 5 years.
But Governor said he will appoint another committee to look at that framework.
That could well be true, but then the fundamental argument that I do not get any transmission unless I keep the system in deficit liquidity a 0.5 percentage point or thereabouts, I think that still remains the case. So my guess is that to ask for surplus liquidity, that is breaking away from something over the last 5 years, and that will require a significant change. Now, this new framework could say, look, we can go back to surplus liquidity, but I doubt that we will be ever going back in the near term to a situation where we put the system into surplus liquidity.
Okay.
We can ask for reduced deficit liquidity. I think that's really where the question is, that if they had promised 0.5 percentage of deficit liquidity, at least meet that target rather than starve the system with more deficit liquidity. I think that argument is a valid argument.
Okay, well, I will take Srini's views on that as well, but we have to take a mandatory break. Back in a minute.